Good afternoon. We are excited to welcome you all to today's expert roundtable discussing best practices in fundraising. So some of you might have joined us on a few previous sessions, but this is the fifth event in our quarterly expert roundtable series, following our earlier sessions on DE&I, go-to-market strategies, building world-class teams, and product market fit. So today we're going to be spending some time with a fantastic group of digital health leaders, executives, and entrepreneurs. They've all raised capital from some of the leading healthcare and technology venture capital funds. We're going to learn a little bit more about their fundraising journeys, how they identify the right investor partners, and how they opportunistically, I would say, navigated fundraising during this really dynamic time in healthcare capital markets. So we're super fortunate today to be joined by four amazing entrepreneurs and leaders. Julia Cheek, she is the founder and CEO of Everly Health, and a first-time CEO who has guided the rapid growth of a modern diagnostics care platform that's raised actually several $100 million to play a really critical role in powering our consumer testing infrastructure throughout the pandemic. Our second panelist is Ankit Jain. He's the founder and CEO of Infinitus Systems. Ankit's a two-time entrepreneur, a former senior leader at Google, and a founding partner at Google's AI fund, Gradient Ventures. Ankit's now building one of healthcare's first voice automation platforms. Our third speaker is going to be Janine Versi. She's the co-founder and COO of Electra Health, a Flare Capital portfolio company that brings high-quality care to women going through various phases of menopause. Janine's a former Googler who spent actually her entire career in healthcare, tech, and government. She was on the founding team and a VP of clinical programs and partnerships at CityBlock Health, was an early hire at Valera Health, and among others, and in the Obama administration and White House. And she's a Blavatnik Healthcare Fellow at HBS right now. And then finally, our final speaker is going to be Meredith Whitney. She's the CFO at Kindbody. She's the former CFO at Zoom and a renowned businesswoman with a deep knowledge of capital markets. Meredith was recognized by Fortune magazine actually as one of the 50 most powerful women, and Time magazine is one of the most influential people in the world. So again, fantastic panel. We're really excited to kick things off. We'll structure the hour into 4 15-minute fireside chats, and we're going to start things off with Julia. So without further ado, I'm going to hand it off to my colleague, Bill Geary, to kick us off with Julia. Bill?
All right, thank you so much, and great to be with everyone today. Julia, welcome to the stage. Great to see you.
Great to see you. I'm excited to be here.
We're excited to have you, and huge congrats to you on the company you built. I know we want to focus mostly in our discussion with you about this growth stage and your fundraising success. Your last financing round was about $175 million. I think you've raised a total of about $325 million along the way, and it's been all straight up and to the right for you right from the get-go.
Yeah.
But first, I really want to talk about what got you interested in healthcare. You have a mix of experiences, nonprofit, fintech. So what was it quickly that sparked the healthcare interest?
Yeah, I just want to say thank you to Flare. I have known you all for a number of years and just really impressed at how you bring these conversations together for founders. And also the panel that you've assembled here today is likely a little bit reflective of some of my experiences in fundraising, because when I started, I was a first-time founder. I'm obviously a female founder, had no healthcare experience, was a non-tech founder, and I was living in Dallas. I was every venture capitalist's dream to back for a risky, high-risk check. And, you look at my background on paper, and frankly, I probably wouldn't have taken the bet on myself other than knowing what I know now, which is I knew the problem deeply. I was identifying a key consumer market with a very large TAM, an infrastructure issue, and I knew that there were people I could surround myself with to make this a success. And frankly, if I had actually had healthcare experience, I'm not sure I would have done this, because I think it gives you a little bit of optimism around not knowing just how hard some of this infrastructure change could be. And I think that's really important in innovation in healthcare. And so when I had this idea, it seems like it was very dramatic. If you look at my background, I was a consultant, went to HBS, then was a nonprofit in fintech. But since my time at HBS, where I had the privilege of being surrounded by a number of different founders who became friends of mine, I knew I wanted to take this chance. It just took me a number of years to find the the particular issue area that I both felt was something I could spend decades of my life on changing and be motivated by and passionate about, and to feel like it was the right time and the right opportunity. And for me, I left my job. My husband was also a founder. And so we had all these dramatic moves like selling our house, moving to Austin, all those things. But it really was better planned than that, and was years of really assessing both my passion, different industries, and timing in the market when I decided to do this in 2015.
That's amazing. You've overcome a lot and just built an incredible company and brought attention and focus on a market segment that I think was overlooked. There were a lot of naysayers in the beginning.
Yeah.
And so have you distilled some of those fundraising lessons, and what would you pass along to the people that are listening and with us today?
Yeah. And just for those who don't know, Everly Health, which is the parent company for Everly, which is the original brand that I started in 2015, provides easy, accessible, and insightful lab tests directly to consumers. And so we had started really in the women's health space, and women continue to be about 75% of our consumer base in a company that's testing millions of people per year. And so that was really how we got started. But if you can think about what the problem set looked like in 2015 and me pitching for funding, it was, we don't think this is a problem because insurance pays for everything. We don't understand the problem in women's health, and the lab testing infrastructure and care delivery model as a focus had not been something particularly highlighted in healthcare. And digital health really was still in its early innings of really understanding if it was going to take off as a core model. And so obviously we'll get into the pandemic a little bit, but certainly the early trends of what we saw, and I think a lot of the legitimization of digital health, has been a silver lining of what we've been through in the last 2 years. But in the early days, it was really hard, frankly, to convince anyone that this was a problem. And most of the VC funds who would actually reach out to me for meetings had heard women staff members on their teams, usually, frankly, not their investing members. Many of them didn't have female investing team members, talking about our product and how it had changed their life. And so that was oftentimes how we would get these meetings. And it was still just a lot of hard yards to overcome in terms of creating the explanation of the problem and how this would really solve it. Now, what I think we were on the early sides of that's now become true is the significant out-of-pocket and economic burden that has shifted toward the consumer, as well as obviously, and I'm sure with Kindbody you'll hear about this, but the somewhat undiscovered nature, unfortunately, of women's health as a focus area. And so when I was fundraising early, just to speak plainly, I did not have the luxury of evaluating or choosing partners or evaluating or choosing valuations. And frankly, part of the grit is you make it work. And so I had 2 angel rounds, I had 2 convertible note rounds, and I even delayed a Series A because even though we were delivering about a $5 million a year run rate, I couldn't get the valuations that I thought the company deserved. And I share some of those stories because I continued to fight for a business that I knew needed to be delivered at scale. And I sought alternative methods that aren't as clean as some of the paths that I think fortunately founders are raising in today, which is you do the pre-seed, the seed, the A, et cetera. And so just want to bring some light to the fact that sometimes you have to piece it together and create what it takes to be able to keep the company in business.
Yeah, no, that's really well said. You didn't have the luxury of selecting the right investors from a large pool at every turn. You were super creative. And then, of course, what's happened in the last 18 months, unfortunately, has been an accelerant for many digital health businesses, yours, of course, included. And you really positioned yourself and positioned the company, you and the team, quite effectively. So tell us what it's like to raise capital during a pandemic. You obviously had the opportunity to pick the right investors now, raised a significant growth round. And what was that like? And what are some observations from that experience?
Yeah. And I will say I've been very fortunate since our Series A that I have been able to be discerning and really to have mission-oriented investors with us on the cap table, long-term holders, people who really believe this is a generational company and have put together a good combination of consumer and healthcare experts. And so when we raised a Series C in February of 2020, 2 weeks before the capital markets imploded for a short period of time before rebounding, which was a great round for us. And we were on still a really great growth path at the time. We doubled or tripled every year. And then we went out to raise a Series D at the end of 2020 when it became clear that not only were we leaning into creating solutions around COVID testing and diagnosis, but our core business was also tripling. Actually, I think it quadrupled in 2020. And so the challenge with that is you can't move resources around. You actually need to scale infrastructure for all aspects of the business, which was not something we had predicted. And I was really fortunate throughout my fundraisers that I've had either preempted or key partners that I've already gotten to know over the years that I was able to work with on the Series D. And when we ended up closing, we actually brought on HealthQuest, who many of you may know is a bit of a later stage growth fund, and brought Garheng Kong on our board, who also sits on the board of LabCorp. And we were able to elect and say, who do we really need around the table at this stage? We're now going through FDA authorizations. We have a deep regulatory and clinical practice. I knew I wanted to make some transformational capability moves through acquisition this year. And I was fortunate because of the way that we built the company that I could get that legitimacy at this stage, which was really what we needed. And ultimately had built a relationship with Garheng months before. And so then I was able to have that trigger to pull when I needed it. And I do think I can tell you at every round of fundraising, no matter how early, people who it was a little too early for, maybe 6, 9, 12 months before, I've been able to build relationships with, and then frankly, do my own evaluation of our partnership before bringing them on board in a bigger way. And so that's a tip I always recommend. And I know you hear it a lot, but really, if it's not a no, and people really want to engage on the company and can lead later on, that often is how it'll happen.
And you're in a period now of, again, continued rapid growth, building out a great team, a great board. So are you envisioning that maybe there's a public company here? Or how are you thinking about what could be next?
Yeah, I think what an amazing time to be in digital health. I have never been as energized about how we're innovating, particularly on diagnostic care delivery, but also I think all of these different models, mental health, in-home visits, all those things that we're seeing, that I'm super hopeful and positive. I don't think you're currently seeing that reflected in the public market comps. And actually, you're seeing a bit of dislocation with private market valuations. And I think that'll be short-lived, I'm hopeful. But certainly the next, call it 18 to 24 months, will be the moment for these various digital health delivery models to really prove that they can scale. And so that's really what we're focused on. We're fortunate to be self-sufficient and not needing to go out and raise capital, which has been a great way to control our own destiny. But we do want to continue, I believe, especially in diagnostics, this is a particularly novel moment. And so we want to continue with M&A and organic growth. And so we'll likely be looking for ways to do that. I'm hopeful in the future. I think we'd be a great public company, but it's not on our immediate path.
And how do you think about the regulatory approval path that you've navigated so far and will continue to navigate? Has it been an obstacle? Is it part of your moat once you competitively, once you've successfully tackled that strategy, or has it gotten in the way?
Yeah, I think it was a really huge credibility mark for us to get to partner with the FDA during COVID. And in diagnostics specifically, we had a lot of different accreditations that were not FDA, but were CAP and CLIA and CMS reviews and all those things, but hadn't had really a pathway to engage with the FDA because our products and the way that they're regulated weren't a top priority at that time. So we're actually really excited about it. And we have a number of 510Ks as well through a company that we acquired in March called Home Access Health Corporation, and have continued working with the FDA on how we can think about transitioning both our COVID products, but eventually working through our other suite of tests as well. I view it as not necessarily a quality differentiator per se. It can be, but ideally companies are holding themselves to those standards regardless. I do view it as a significant and important mark of consumer trust, as it should be. And so being able to communicate that to consumers that we meet those standards in a really clear way is something we're actively working on. And we've really stepped up our overall regulatory strategy, not just with FDA, but also with CLIA and CMS and CAP, which are the agencies that by and large regulate most of the lab testing in the country. And so that's something that we'll be focused on as well. This is the question of how do you help digital health companies in earlier stages of funding? given the cost of some of this infrastructure and compliance. And I do think you're starting to see a whole suite of startups, Medallion and others, even things like TruePill crop up that can help provide some of that infrastructure in an outsourced way so that companies don't have to make those investments in early days. We had to build much of it from scratch, and I'm hopeful that the pace of innovation will actually increase with some of these companies that are built as scaffolding around these new delivery models.
Great observations, great insights. Last question for you, and you touched on it earlier. We want to ask all of our panelists, what's your perspective on valuations for private companies? Can the momentum sustain, and what's going to happen if things correct?
Yeah, I feel like the older generation that walked uphill to school both ways a little bit and shares those stories. I think that I referenced the dislocation in public and private markets. I'm curious to see when companies need to or want to exit, what that may look like in the coming years. And so my concern is really more, how does this translate into strategics or public exits rather than can these valuations keep spinning up and up? Because the incentives work on all sides for that. Where they may not work is in the actual liquidity event or exit. And so I'm hopeful that these models have the fundamentals, the businesses have the fundamentals to support those exits so that we don't actually see a cratering of valuations, which frankly will just hurt the earlier stage companies. But I think it remains to be seen.
That's great. Julia, huge congrats to you and your team on the company you built. And thanks for the relationship that we have with you. And I really appreciate you being with us today.
And I'm excited to listen to everyone else. So thanks for having me.
Thanks so much, Julia. Talk soon. And Parth, now I'm excited to turn it back over to you.
Awesome. Thanks, Bill. And there we go. Thanks, Julia, as well. Ankit, my friend, welcome. Thanks for joining us here today. It's awesome to have you. I think we're excited to hear a little bit more about you and the Infinitus journey. Ankit, you have this really interesting background. You built and sold a couple of businesses. You're a former Google exec. You helped Google launch Gradient Ventures, which is their AI-focused fund. So you've really spent some time on the operating side of things, on the entrepreneurship side of things, and then investing. So many different vantage points. What led you down this path? And I'm speaking about Infinitus. After all you've accomplished, what's the Infinitus origin story? What drew you to healthcare?
First of all, thanks for having me. It's always good to spend time with you and the Flare team, and glad we can have this conversation. Our origin story is interesting because I don't come from the world of healthcare, and it's interesting. I'm 2.5 years into this journey, and I feel like I'm still day -10, learning new things every single day. And every time I talk to a partner, a prospective customer, or a prospective employee, and I tell them there's just so much to be learned in healthcare. But the one thing that has been constant is the motivations that everybody has. Everybody wants to try and make the healthcare ecosystem better. And I started noticing this as an outsider when I was on the Gradient side. As I was making investments, I found myself making a few AI investments in healthcare as that was taking off. And every time I went to help one of my companies, there were tons of people that just wanted to help. Every door was opening because people wanted to be part of that digital transformation. That was really heartwarming to see. I think that's very different than most other industries, most other ecosystems, because there is so much opportunity. And I think that's something truly special about healthcare. The specific idea of Infinitus came out of an event so Google launched in 2018 something called Duplex, a system to automate phone calls to make reservations to spas and restaurants, and it's since expanded. And I was showing a demo of this to my wife. My wife has been in healthcare operations for about a decade, worked at home health and hospice clinics, at hospitals, in pharma, at urgent care centers. And I was telling her about NLP and speech to text and text to speech. And she looked at me and her eyes were glazing over, and I don't know what those words mean, but I wish someone would build this for healthcare. And I'm like, what do you mean? She's like, if I want to go to a spa, I'll make my own damn reservation. But there's patients waiting to get on therapy, waiting to get a surgery done, waiting to do a diagnostic like an MRI, which is being scheduled 2, 3, 4 weeks out because there's a bunch of back office processes that need to happen. And they're happening over phone calls and over faxes because that's the state of healthcare. And so if someone was to bring this technology to automate phone calls, especially structured phone calls to healthcare, it would fundamentally change two metrics: the cost of healthcare and the time to therapy for patients. And that was the journey where Shyam and I started working on this project, which has now turned into a company and something that we're very proud of and still just getting started on.
Awesome. No, that's great context, Ankit. And with this journey, as compared to your previous journeys, as you mentioned, you're going after this opportunity in healthcare, and healthcare as an industry to some extent was new to you. And so how did you approach thinking about which investors to partner with, who you wanted to bring around the table to help advise, guide, to be of resource to you on this journey?
Yeah, it's interesting. I think I'm going to step back and talk about my first company, which I think is a big contrast to Infinitus in many ways. When I started Quetra, there was a technology innovation that I was very excited about. And I was like, I want to go build a company around this technology. And we built out the technology in a vacuum for about a year and a half before we started selling anything. We got investors just because of the team's background. And then we found ourselves looking for a business problem where we could apply that technology to, which ended up being something that was interesting. It was competitive intelligence, but not something that we knew anything about whatsoever. So here we were running around with technology, trying to find a business. Stark contrast to Infinitus, where the origin was because there was a clear problem. After my wife told me that, I made about 150 phone calls to every doctor's office, every physical therapist office, every dentist office, I walked into every pharmacy in the area, and I asked the front office staff member, have you made any phone calls today? And everyone's yes. And I hate making them because I much rather be serving patients. And I think in this case, we knew the business problem. We knew that we had the chops to build the technology needed, even though we didn't know what the exact technology solution was going to be, but we're like, we can figure that out. That's the part we had confidence in. And so then it became a question of who are the right people to build that village. I'm a big believer that a company is really building a village. You want to have every layer of your close advisors, folks that are also helping you think 2 steps into the future. And to me, it was at first, before we committed to this being a healthcare company, it was a conversational AI company. I said, let's find investors that will help us build a good early stage company. And Kleiner Perkins and Ilya led our seed round. And the idea there was Kleiner has done things across every industry in the last 35, 40 years, and they can help us as a good partner as we build the basis of the company. Our Series A wasn't one that we had planned. Coatue came in and preempted our round, and their pitch to us was that they're seeing the public markets as a traditionally public market investor and now getting into the private markets. And so they'll help us see 2 steps ahead. They'll help us connect with some of the larger entities that are buying this kind of technology that they know from their public market investing segments. And the third thing, they'd done a lot of investment in process automation. So they knew what that sales motion for process automation, whether it was at UiPath, at AbbZen, and a whole bunch of other companies, and give us some insights there. And having known some of the partners there for a few years, we thought it was a good opportunity to get some capital behind the company before we truly needed it. As a VC, I always used to tell my companies, raise capital when you are getting it, not when you need it. And with this bull run that we've had in the public markets, I wasn't sure when that party was going to end. And again, this was in 2019 and we're still going, but it was a good opportunity to get them on board. And then with our latest round that we just recently announced with Google Ventures and Krishna leading it, it wasn't as much about the capital per se, but it was about making a round with a lot of healthcare executives, a lot of healthcare leaders, healthcare investors, because over the last 2 years, we really have leaned into healthcare. We really are that healthcare voice automation company. And so we wanted to bring some of that DNA even on the investor side of things. And that's what we did with our Series B.
That makes sense. What a logical sequence. You started working with some of the folks you knew and you trusted, and then you layered on the right expertise along the way as you saw different inflection points in the business. That's awesome. Maybe taking a step away from Infinitus here for a second and just thinking about your broader journey, your previous 2 endeavors. One question I think we get a lot, and a lot of early entrepreneurs have, is around strategic capital. And you've been in this, again, you've helped advise companies around when and maybe when not to take strategic capital. I'm sure with your previous endeavors, you've run into this before. What are the pros and cons of strategic capital from your perspective?
Yeah, I think every company is about having clarity of vision and mission. And I'm a big believer in optimizing for what gets you to that in the straightest line possible. And there are often companies that can be a catalyst to chopping a few years off your journey. Sometimes this comes in the form of a strategic investment. With my last company, there was a company out of China that had distribution on about 150 million mobile devices. And in return for investing in our company, they got our software distributed on all of those devices. And it was an incredible partnership. It wasn't a party that I think anybody in Silicon Valley or in the US startup community would even know about. But we happened to get connected with them and they were a great partner. On the other hand, I've also heard of a lot of strategic investments where you go into it, you think there's going to be this very productive partnership, capital is put into the company, so this strategic investor is on the cap table, but a commercial relationship never comes to be, in which case you've got cap table space with someone that is not helpful to the business. So I think the advice I always give entrepreneurs and friends and others considering strategic capital is really ironing out what that commercial relationship is going to be before thinking about a strategic investment in a company. That said, I also like to keep the commercial agreement and the investment agreement completely separate, because you don't want those muddying each other, because it just causes complications down the road.
Very well said, Ankit. Maybe just to flip to a different topic here, I want to talk a little bit more about product and technology products in particular, software products in healthcare and fundraising proof points. As you thought about raising capital, or when maybe theoretically the company would be ready to raise capital in each round of financing, how did you think about what the right proof points and metrics were? What did you anchor against? What did you guide your team to track against as you thought about those rounds?
Yeah, almost everything that we do goes back to, is this getting us closer to our final kind of vision of what we want to build, right? So if I think about Infinitus, it's about structuring as much of that human-to-human communication that happens in healthcare so we can drive interoperability. And I think with every round of financing, we've thought about, what does this unlock for us? The seed round was about starting to build the team and the initial prototype. The Series A was about getting capital so that we can tell some of the largest customers that we're not going to go away in 6 months or a year, and that they can invest in us, because we all know that the sales cycles in healthcare are non-trivial, and there's a lot of hoops and hurdles that we have to go through, and having that capital allowed us to do that. And the Series B is really about broadening our horizons, about broadening how we think about the opportunity in front of us. It's about having thought leaders tell us, hey, you can also use this technology in this other part, or if you added on this piece of technology to what you already have, you can expand your product, you'll have a much bigger impact on your final vision, you'll get there faster, you'll be able to tell your story better. And I think it's those kind of milestones, much more so than $1 million in ARR before you do your Series A, or $6 million with 15 customers that are expanding at X% per year for your Series B. Because the truth is, we're in this very volatile market where these benchmarks are changing month after month, year after year. What used to be a Series A 3 years ago is now a seed round. And so I think it's more important to be focused on the vision and the journey to get there, and figure out what unlocks the next kind of step function for the company.
Yeah. Very well said, Ankit. And we're right up against time here, but I want to make sure that all of our panelists get to answer this question, because it's a really top of mind one. But maybe in the last 20, 30 seconds here, just your thoughts on valuations, Ankit, especially for high growth technology products. How did you think about it? Risks, pros and cons that future entrepreneurs should be thinking about?
I think, again, as an entrepreneur, you're taking a shot at goal. You get one shot at goal every 10 years, if not even longer sometimes. And you should focus on your vision. You should focus on your mission. And if that means you take a little bit of a haircut on valuations, but you get the perfect partner to unlock you, that's important. That said, in today's ecosystem, I don't think cash or valuations are the limiting factor. It's your ability to execute. And so if you have that belief in yourself and others have that belief in you to go execute, well, this is the best time to start a company and get the financial backing. So that's not the reason you fail, and build the biggest companies possible. And I think, as Julia previously said, it's probably the best time ever to be a digital health entrepreneur, and super exciting time to be doing this, and very privileged to be able to have this opportunity to build Infinitus.
Awesome, Ankit. Thank you so much for joining us and sharing some more about the story. Really appreciate your time and insight. And I want to now hand it over to my colleague, Vic, who's going to be joined by Janine Versii to talk a little bit more about her health. So thanks again, Ankit.
Thanks, Parth and Ankit. And my extreme pleasure to welcome to the stage Janine Versii, as Parth mentioned earlier, the co-founder and COO of Electra Health, which in full disclosure is a Flare Capital portfolio company as well. In some ways, on this panel represents the earliest stage business that we're going to talk to today. And as people have mentioned, as time has moved on and metrics have changed, the world of raising seed capital has changed a lot with it. So, Janine, you have a super interesting background. You've spent time in policy, you spent time in a big tech company at Google, at CityBlock, which is now a later stage health tech business, before launching Electra. So I think before we dive into fundraising questions, people would love to hear a little bit more about the company and your journey to founding Electra Health.
Thank you, Vic. And it's an honor to be among these panelists. Very happy to represent the early stage end of the spectrum here. In terms of my background, I've had a varied path across government and tech and healthcare, was on the founding team of CityBlock Health, which I'm sure many of you are well aware of. And I was number 10, so it was really early at CityBlock. It was incredibly exciting to be part of this kind of complex model around full stack care. So I got to help build and grow a business that saw brick and mortar, digital, and remote. And as the market continued to mature, CityBlock grew. I became increasingly aware of, as sort of Julia was referencing, this growth of quote unquote femtech, and was particularly interested in what was happening in that space. And noting that a lot of the innovation there was really confined to the reproductive window, in particular services around fertility and maternal health. And we need that. We actually need much more of it. But it did leave this gaping hole when we think about the spectrum of women's health for women who are navigating perimenopause, menopause, and beyond, which is a third to half of the female lifespan. And part of the reason I was attuned to this in the first place is just personal background. I come from a family of physicians. My father, in particular, was an OBGYN who subspecialized in urogynecology and started that department at the Brigham. So I grew up around academics who focused on women's health in midlife. And then fortuitously, a friend introduced me to my now co-founder, who is a brilliant consumer tech, very experienced in that world. That's Alessandra Henderson, as well as our founding physician. So the three of us really the founding team at Electra, and we came together around this mission to smash the menopause taboo. And I can explain what that is and what we do, but that was really the impetus from day one.
Awesome. And we're going to talk a lot about menopause in a bit, but maybe taking a step back and thinking about the context of the company in this round. So for folks' benefit, Electra Health raised a seed round. It was a $3.75 million seed round this past summer. Flare Capital and 776 were the kind of co-lead investors of that round with a number of other groups alongside that. And when you were thinking about this round and that size, what were the key considerations of the structure? Were you thinking about round size in terms of runway and time? And as you thought about the syndicate and constructing that, what are some lessons learned from that process?
Yeah. So to give a little context to the folks who don't know, Electra Health is focused on serving the 50 plus women in the US and millions more around the world that are navigating menopause. And we do this with evidence-based education, virtual care, and community in the first full stack digital platform. So we offer a suite of services to help women along that journey, which is potentially 10 or 15 years, both with board certified specialists providing telemedicine. And then on the other end of the spectrum, part of our learning here is that care doesn't necessarily mean clinical care. It oftentimes is very effective. And I think we see an analogy in the mental health space to have coaching, what we sometimes call the services of a menopause doula, as well as a multifaceted approach with content and community. And so that's what Electra provides. When we were going out to raise a seed, what Julia said really resonated. There's a lot of similarities. I think what she was saying was true even 6-7 years ago when women's health was still true when we were going out to raise. So we had started with a pre-seed in 2019, and then we were pretty focused on being heads down, helped perhaps by a pandemic. We had launched a telemedicine business. We were really focused on delivering care to meet the care gap. And then over the course of that year, really understood, I think, what our consumers wanted, which was not just clinical care, but this spectrum of services that I was alluding to. And that helped us crystallize the product that we needed to build and the team around it. So when we went out to raise the seed, everyone tells you to run a tight process, which like always sounds really great, but in actuality, you don't necessarily have that choice. We were as intentional as we possibly could be, but always aiming to be flexible and opportunistic. We aim to raise enough capital to be able to build the product and build the team. It's healthcare, it's regulated. Telemedicine services are not a high fixed cost business. And so that was really important to us out of the gate. And then we were fortunate, it took some time, but really fortunate to ultimately have an oversubscribed round led by what we had hoped would be true, a leading healthcare investor in Flair. And then also as a consumer-facing business, we wanted to have some deep consumer expertise. So the two together, and similarly, Julia described this too, creates a really important synergy. And so that is Flair and 776, who co-led, and then also some really fantastic angels, in particular, women in our demographic who understand the issues, who are champions for us, punch well above their weight in terms of sometimes the checks that they write, but with the effort and energy that they bring to Electra and that value that they can unlock.
Yeah, I think it's an important point, especially at the seed round, is the value of angels. And in this case, there's a number of angels as part of the investor community at Electra that, to your point, certainly do punch above their weight. I'm curious how you're thinking about just balancing that and then maybe transitioning a little bit into, did you have a set of expectations around, terms, valuation, et cetera, at the seed stage, or did you take a different approach?
Yeah, and we started, I think our pre-seed was helpful because we had a number of strategic angels. We had some funds, but we also had some individuals. And one of the things that I think anyone here starting out would probably attest to is just the importance of other founders and the community of founders that really help you along the way, many of whom, if they've been successful, end up writing checks. And so I think learning about that through other founders and having some of them join as strategic angels was really helpful as early as the pre-seed. And so by the time the seed came around, we did understand that was really important in terms of the strategic value that they can unlock. And so we were specifically looking for folks who understood the problem, understood the demographic, understood the particulars of our go-to-market. So consumer facing, we really do see an important enterprise opportunity in this market. The US is, in terms of menopause services that employers and payers are focused on, not as mature as some other markets, like the UK, for example, where you have banks and insurance companies investing in menopause services for their employees. We are pretty confident we're moving in that direction, but taking an eye to strategic investors and angels who can bring some of that expertise to the table was really important for us. And then in terms of evaluation, I think everybody wants to get a great deal, a fair deal. It is really up to the market. And to the extent that you can be choosy and selective, we really took a view to partnership and who do we really want to be sitting around the table with and hashing these issues out with like day in, day out. And I think with Flair, I met Dan, 8 or 9 years ago. Alessandra knew Vic. And so those personal relationships really matter when it comes to trust and figuring out who are the folks that you really want to have around you to help create that value.
Awesome. And before we move on to the kind of broader market, more about the seed round. So anything about the process surprise you that you weren't expecting going into it?
It was interesting that femtech, quote unquote, had received so much attention. People were very interested in menopause as a space. But one thing that we observed was just the sort of flattening of women's health into one investment or one part of a portfolio. It was like, oh, we've invested in a maternity care startup, kind of check that box and not necessarily looking beyond it, when in fact, women's health contains multitudes, 50% more of the population really the chief health officer of the family and the folks that direct a lot of the buying decisions, both in the workplace and at home. And on a little bit of a short-sighted perspective that we ran into here and there, I think even in 8 months, the interest in the menopause space has really changed. It has moved increasingly mainstream. And I worked at a mental health startup 6 years ago, Valera Health. And I remember some of those conversations and how difficult it was to really convince people. They could say, yeah, this is a problem, we get it, but is there really an opportunity here? Is there a business to be built here? Some of these things just take time, but that was at times surprising in the seed process.
Yeah, and I'm trying to be mindful of time. Got a couple more questions, but the important one is we need to talk about menopause and smashing the taboo of menopause. And I'll be the first to admit, I had a lot to learn. I still have a lot to learn, and I'm very grateful for being along the journey there. When you were talking to new investors, how much education of this topic was there? I think even maybe a year or two ago, it seemed like there wasn't a defined grouping of startups focused specifically on menopause. Now it feels like a category with a few companies in it, maybe a little bit more. So how did that process go? How did you educate the market for investors and potential future customers?
Yeah, we definitely see our job as educating basically everybody and across the spectrum. And that includes customers who might not be aware that there are solutions. And a lot of menopause companies are products that are related to like skincare or OTC solutions. So they're the distinction around when you provide clinical services and you can actually treat and care for women along the spectrum is an important one. And Electra is one of the very few that I think delivers that with an NPS of 93 on the clinical side. We were doing a ton of educating, and I think there's no shortcut to that, but it can just practically be challenging if you're sitting down with an investor for a 30-minute conversation and you're going to spend 20 minutes of it starting with the basics of menopause. This is 80% of women report symptoms and women are in menopause for the rest of their lives. And just explaining the implications of both on outcomes and in terms of costs. There's not a ton of data in this space. It's one of the many issues that we have, both in women's health and then even more true in menopause. Vic and I have chatted before about when an investor says, oh, I'm going to go home and ask my partner or my wife about this. And honestly, I think that's great. I think the more people that are talking about this, the better. And you can really tell for the folks out there that are going to be raising and talking to investors, those that are doing the homework and doing the research and coming with really thoughtful questions versus those that are like, this sounds like a hot space and I'm just going to learn on your time. I think you get a lot better at differentiating between the two as you move on in the fundraising process.
Awesome. And I think that's actually a really great note to end on. And I'm also getting the hook to keep us on time. So really appreciate you spending some time with us. And this has been a great conversation. I'm going to turn it over now to my colleague, Michael, for the last conversation of the day. Thanks, Janine.
Hey, thanks, Vic. And I'm delighted to welcome my pal, Meredith Whitney. Meredith, great to see you.
Great to see
Meredith
you.
has been described over her tremendous career as an oracle of Wall Street, according to Bloomberg. And so when she joined Kindbody, it actually, many of us took great notice around that move earlier this year. Meredith, maybe before we get into a couple of questions, I'll let you more properly introduce yourself and give a soundbite around Kindbody and what you're doing now. I think that'd be super helpful to hear.
Oh, sure. I came to Kindbody in April after a career on Wall Street. I started out as a bank analyst, and you always think you never really leave your roots. Once an analyst, always an analyst. And it's the numbers that drive everything. And by the way, excellent group of speakers and not surprising, Michael, a really good conversation. The industry my background is I started as an analyst. I was an analyst with people either cared or didn't care about financials until they really cared about financials in the credit crisis. And I was ahead of the curve and stayed ahead of the curve. So I was shocked that I was so far ahead and stayed so far ahead because, as everybody knows, I was working with public data. Anybody could have done it, but people weren't doing it. So you imagine the unimaginable has to be on your radar screen. As an analyst, you are by definition an entrepreneur. You're supposed to see trends. You're supposed to guide your own posts. You're not told what to do. And so I love that aspect of it. I love even more being on the operations side of it. And as the not Janine, but the speaker before was saying it's all execution, and execution is hard, and getting the trains to run on time is hard, but it's also really exciting. In the femtech space, women's health and particularly fertility, there are very strong similarities between what's going on today and what went on when I started my career in the 90s, in that securitization lowered the cost of capital and democratized credit. And today it's the role of technology that is lowering the cost of care and democratizing care. And it's so exciting and it's so thrilling to be able to go on this ride, not just once in my life, but twice in my life.
Yeah. And so I think why I wanted to close this conversation with you, Meredith, is you really nailed the onset of the financial crisis. You are very visible. You are very forward. There's a lot of rhetoric today that our sector is frothy, overvalued, hyperkinetic. Yet you joined the sector, and I'm sure you did all that fundamental analysis. So what's been pleasantly surprising with healthcare? What have you been a little bit surprised, maybe unpleasantly surprised? What are some of your early insights? And then where I'm going is, how do we finance in this environment?
Yeah, I think that what is not surprising to me is the chasm between legacy operators and new operators. And what I mean by that is the technology debt that exists with legacy operators creates an environment where they cannot grow and they cannot compete. So you've got an incredible environment for those without technology debt and a brand new frame and a brand new mousetrap to take on dramatic market share gains. And not only is the market share shifting, but the pie is growing. And that's a secular trend that will not change. And so how do we finance it? I think it's, as Janine said, it's just really education, right? We're opening up worlds of care and markets that hadn't existed before. And so if investors think there's a finite pie, they're going to allocate said resources to that finite pie. As the pie grows and more people understand that the pie grows, then there'll be more capital allocated. I'll give you an example that you know well. In 2019, I think there was like 140 million of capital raised with femtech, what's called femtech, which Janine said very well, which is such a blanketed umbrella category. In 2020, it was 150, and year to date, it's been over $1.5 billion. And so if nothing happens, and then everything happens. And I don't see that changing anytime soon. And because there have been so many great entrepreneurs in this space that are educating, that are moving the needle, that are getting more attention, we're all doing each other a favor.
Yeah. And so do you worry about an issue that we often talk through is capital absorption? Is that too much too quickly? What's your advice? You're in one of these emerging winning companies right now at Kindbody. Should entrepreneurs take as much as they can? Should they be more cautious? How are you thinking about positioning in that environment?
I am a belt and suspenders person by nature. And so not having a grasp over how long a market could shut down, and cash is your runway. And I think you raise as much cash as you can so that you can keep your head down and execute. So you're not going to worry about things. And if I think there's also, so there's a certain size company that has an easier time raising money than the very small companies. So there's also opportunity for consolidation and for the larger companies to seed grow some of the smaller companies. And so I think that there's going to be more and more capital flowing into this sector. That said, it's all personality types. My personality type is belt and suspenders, because there's so much opportunity. You want to grow as quickly as possible. And I think one thing that I found very informative in terms of the Uber model, when they were growing before they went public, they raised as much capital as possible so they could basically stomp out competition. And today they have one smaller competitor, but it's Uber everywhere. And there's an opportunity to be that. I think Row is trying to be that. There are a bunch of companies can be that.
And it certainly feels like the next 2 years will define the next 5 years. I think the next 5 years starts to define the next 20 years. So if you haven't crossed over to become one of those emerging winners, what's the path forward for some of those smaller companies? What would you say to those entrepreneurs, those founders?
Some of the things that I've heard today, which is be really careful who your partners are, because capital is only going to get more expensive for those smaller companies.
Yeah.
And with the wrong partners, you could fall into unfriendly hands and you don't get out of it, right? So
Yeah.
choosing the partner is so critical because they really have to be a partner. Otherwise, you're just going to get gouged.
Yeah.
And do it sooner.
Yeah. When Bill and I started the firm 7 years ago, healthcare tech venture was about $4 billion. This year, it may be north of $25 billion. I assume as you look forward over the next 2 to 3 to 4 years, you see it closer to the $25 billion, not going back to the $4 billion. Is that your orientation, that we're in a pretty robust financing environment over the next couple of years?
Yeah, I think a couple of things happen, and I'll just speak to healthcare in general, our specific area of focus. The labor market is so tight. We were talking with accountants earlier this week. The level of attrition has spiked to 30%. That's just unheard of. So
That's crazy.
whatever you can do to attract and retain talent, and then also manage costs, right? There's a silver lining to everything, which is healthcare costs go up, but then it's like oil prices going up. Then you switch to alternative forms of energy, alternative forms of care. And I think there's so many great companies out there, new entrants out there that are going to answer a lot of those questions, lower cost of care, and provide something that employers can lower their overall cost of keeping employees happy and well cared for.
Last question. I'm sorry, we're running up on the clock. What are the signals then that you would look for if you thought a correction was forthcoming? You nailed it before in your career on Wall Street. Are there things that you're monitoring in our sector?
Yeah, I always think the last time, correct me if I'm wrong, the last time you had a massive correction was really at the same time when WeWork went tapioca. So you had Bernie Care coming out, and it's when the credit markets freeze. And but that's an old school way of thinking, right? There's so much money on the private sector, but I think when the credit markets freeze and when investors put their pencils down, you can feel it coming. And then it's just a question on how long it lasts. And the last time it didn't last, this is going back to September 17th. Got to remember it like it was yesterday, 2019. But you felt it was coming. And then it returned to normal January, February. So this is getting back to your point. If you can raise cash and make it through any type of market disruption, it's the easier way to do it. And if you think short term about dilution, but it's dilution or extinction when the market really goes sideways.
That is a great soundbite. If we take anything away, dilution or extinction, that is a brilliant soundbite. I'm going to turn the mic back over to Parth Desai to close us out. Thanks, Parth.
Yeah, dilution or extinction. I love that. Great way to end an awesome conversation. Thank you to Meredith. Thank you to all of our speakers. And thanks to all of our guests for joining. And in the meantime, please reach out if you want to continue the conversation offline. Thanks, everybody.